Welcome, Masterminds, to today's video where we are going to be exploring engineered liquidity. Engineered liquidity is one of the main concepts and one of the main four core pillars of the algorithm. And as we know, it is utilized by understanding where the gas is in order to target the gas. The gas that we refer to, it comes in the form of stop losses. And engineered liquidity is just that one part of the algorithm that is derived upon the gas. Whenever you take out an inducement, you need to take out engineered liquidity and vice versa. With that being said, let's go ahead and get into today's video where you're going to understand what engineered liquidity is, where it occurs, why we identify it, and how and when to apply it. Welcome, Mastermind students, to today's video, which we are going to be exploring in great depth what engineered liquidity is. So as we disclosed in the bootcamp, engineered liquidity is the area that price randomly picks up and then it just absolutely falls away, runs away for future mitigations to be built off of. Now, what it is within a range is it's that first area that initially will pick up, and let's say that we're selling. Let's say we're selling in this instance. Well, it's the first area within a range that randomly picks up, and let's say our order block is right here initially. Well, what happens is price will randomly just pick up and it'll either do two things at this point in time. One is it will either mitigate this higher time frame order block and it'll leave this refinement in the future to be mitigated. And that's the first thing. It'll either mitigate this immediately and keep dropping. But the second scenario is what it can do on a fractal level is what this is going to look like on a smaller time frame is price will look something like this. It'll just randomly go up, right? Take out some form of liquidity right before it, or maybe just one form right after it breaks it. It'll take out some form of liquidity without mitigating any relevant or important order block. It'll just absolutely take it out, maybe just slightly, and then price will just run away. So what's happening over here is it won't mitigate anything to the left, but it'll just do a quick sweep to engineer liquidity for itself to keep selling off. So what happens whenever I say the stack and trap or the scale-ins, the reason that this pullback is occurring right here is because there is some form of structural, quote unquote, or order block over here that is going to be acting as a smart money trap. So on here, on the lower time frames, what a lot of traders are failing to acknowledge is that on the higher time frames, price is actually just going to continue much lower. And it might end up taking out some form of inducement prior to going lower. And then what's happening is it'll come back to mitigate some form of order flow to the left, to keep going down, to keep going higher, whatever it might be. So what we need to be focusing our attention on is as prices reacting to the SMC traps, or rather order blocks that aren't structurally supported, what's going to happen during this time is price will continue to go lower, and these SMC traps to the left are just acting as areas for price to pull back to mitigate some form of order flow. And then what's going to happen in the future is that these areas act as a form of liquidity that price will need to take out prior to going lower. So where is the actual point of engineered liquidity? Well, the first point of engineered liquidity is what's randomly forming after we have this huge imbalance over here. It doesn't mitigate anything relevant, and then price just keeps going down. So in the future, this is what we refer to as the transactional point of the algorithm, because after we take out a large gas station or a large structural point on the next highest time frame, or the higher time frame after that, after we collect a lot of gas, this gas below this low is what's allowing us to go higher. But in order for us to go lower, right, resume a structure below these lows, we have to collect money above each and every individual internal lower high in a downtrend. And these areas are acting as internal range liquidity points where there's stop losses above all of these highs. And these where the minor gas stations are lying. That's going to cause price to have some form of pullback. With that being said, we know that none of these order blocks are going to be valid for future use based off of the anatomy of the algo, which you will be able to reference in another video. But the actual engineered liquidity point of price is going to be this high right here with this dotted line. So this high right here actually acts as the engineered liquidity point because it is that first point that will randomly pick up with grave imbalance to the left. There'll be no reason, no rhyme for this whole move to happen. And we need to imagine this whole move is unsupported. So after taking out the liquidity to the downside, we need to attack that first internal high that formed right here prior to the structural low being broken. So then what we're going to consider is price just swiftly returning back to this area. Again, there's going to be SMC traps or false order blocks all the way to the right. Reason being, because this is the area that price must come back to all the way up here in order to be efficient again. So we take out this low over here, we take out these highs. All these are false order blocks, and you can expect some form of manipulation or small reaction from these areas just to cause price to go further to take out this engineered liquidity. Now, as we're going to be going over in just a second, the engineered liquidity point is very important. And there's also two things that can happen at this point in time. One of which is, yes, you'll have your refinement over here, but what's more important than focusing on this little refinement is that all price needs to do is mitigate this higher time frame order block. So it can just tap this and then absolutely run. So for that reason, it's important to not over refine your order blocks. Now, at the same time, what's being said is, let's say you have your order block over here. Well, price does not need to mitigate the order block of your choosing. For instance, there could be one just right here. And let's say we didn't see wherever price was going to come to. All price needs to touch is this engineered liquidity. The only thing that we know in the marketplace is what must happen with liquidity, not the refinement of order blocks, since we don't have the order book. With that being said, price can just tap this out, take out the engineered liquidity, because this whole move is unsupported because this little guy right here didn't mitigate anything. So even though all this is mitigating, we need to imagine that after this low is collected with all of the gas, we need to come back to take out this unsupported move that this high didn't mitigate anything and created new lower lows that aren't supported. So these will immediately become targets after a major structural point is taken out. So that being said, this is the approach and view of a sell example. You identify that first point that randomly picked up. And now for the buy example, if I just had to invert the scale real quick, it's the same thing. That first point internally that randomly picks up either mitigates a higher time frame and leaves behind a refinement, or it just randomly sweeps something internally to keep going higher. As soon as we take out that large structure, this low here that's unsupported becomes the engineered liquidity point. And what's necessary is price will take out this low and then continue to go higher because all of the major gas inside of the range has been collected, what's then going to allow price to go and resume externally. So what we need to understand is that within a given operating range, there are two sub-ranges. We have the main range, which we call the pro trend or the external, and then we have the internal range, which is classified by these little gas stations. So what we need to imagine is, let's say that price is currently downtrend in this example. Well, we know that majority of the gas lying below these individual lower lows on our higher time frame would be high to low, lower high, lower low, lower high, lower low. Well, if this is where a lot of the gas is in the marketplace, we need to understand that we need to fuel up for the main gas. After the main gas is collected, we need to imagine that all of these areas of internal lower highs are serving as just the mini gas stations that's going to allow us to fuel up our car, right? So we have to collect all of these areas. And then what's going to allow us to resume is after we've collected the necessary internal fuel, we then are going to be able to resume externally. So in between every individual lower high and lower low on a higher time frame, we need to understand that within this higher time frame perspective, fractally speaking, there are going to be internal lower lows and lower highs. These lower highs in a downtrend are acting as the gas that's going to be essential for us to resume to target lower lows on the highest time frame. So with this being in mind, we need to imagine that there's all this little gas above all these individual lower highs. This is where price needs to collect in order to go lower. Specifically, we're concerned with this area represented by the dotted line, which indicates the engineered liquidity. The engineered liquidity, as mentioned, is the area that first randomly picks up within any given range. And oftentimes you're going to have your extreme immediately beforehand. After price develops this internal random pickup or this random mitigation, it'll then continue lower, and this whole move is going to be unsupported. Price then must return to balance the algorithm, because after we took out some form of low, we need to come back to take out these internal highs, collect the gas, which is going to allow us to continue to go lower. With that being said, lower highs, internal lower highs in a downtrend are the individual gas stations that we need to collect prior to resuming and making new lower lows on the higher time frame or the external trend. Inversely, we need to assume that, let's say this is inverted, right? And we're looking for a bullish structure. Well, whenever we would take out a high in a bullish scenario, we must resume internally to take out some form of internal high or low to collect the gas to go higher. This first point where price randomly picks up is represented as the engineered liquidity point. So now let's go to the charts and envision and apply how we can do this live time. So when we're looking at the charts, this is an example of GU. And what I have illustrated as previously shown through the analogy and through the gas diagram are the inducements, or the structural points are the major gas stations. Inducements are, all inducements is structure, right? So as soon as we take out some form of structure, we need to come back to a lower time frame inducement within that structure, or come back to the engineered liquidity. So we're trading gas to gas. So when we're looking at this example, starting from left to right, what do we see happen? Well, what happens is we have some form of engineered liquidity that randomly happens after a huge imbalance that needs to be accounted for. So what price does is, after we go ahead and take out some form of low to the left, we immediately come back to take out the engineered liquidity. And now what price must do after taking out the engineered liquidity and reacting to some form of order block on a lower time frame is it must then take out this inducement. Well, after we come out and we induce a little bit higher, we then need to do and target externally. So this is going to become the internal range liquidity, that all that needs to be taken within this range, and then price needs to do what? It needs to come back to take out the engineered liquidity in order to then go lower. So as soon as this low is taken out, we need to react from two things. One, an order block to go higher, but also two is take out enough engineered liquidity. So what happens over here? Well, we see a huge imbalance right over here, and we see price randomly pick up once, and then it builds mitigation off of it to then go lower. So this becomes engineered liquidity right here. Now at the same point, yes, there is gas above this high, but notice price just randomly, mitigates and then drops. This is still an area of internal range liquidity, but if you want to imagine it as wherever you see imbalances, the times or the places that price randomly just drops afterwards is engineered liquidity. So we know if we're buying, this will become one target, right? And after it's taken, we act from an order block, price will retrace. And then the second target is going to come the next internal range liquidity, or the engineered liquidity area. So if you're looking to buy, this will become the next target. As soon as this is taken out, the final target will be, of course, further engineered liquidity or inducement. In this case, we have a low, we have a lower low, a lower high, and then a huge lower low. So this was actually going to be an inducement because we're selling above a structural high on the daily time frame, but also, does this mitigate anything that we can see? No, so this is actually acting as both engineered liquidity and inducement. With that being said, let's just imagine this as an inducement point right now. As soon as we take out an inducement, where do we need to come? Well, we need to come back to where? The engineered liquidity. And there's a couple engineered liquidity points over here. Notice we have a huge imbalance right below here. This area that closes or finalizes this imbalance being made, it then randomly just mitigates nothing and then is used for future mitigation. So this is considered the engineered liquidity area where price must come back to when you're looking to sell. It'll always give some form of reaction, but then price, of course, will continue to sell off. So as soon as we make new structural lows, where does the new engineered liquidity area become? Well, we have no imbalance anywhere, but this becomes the first imbalance that price then creates. Where's the engineered liquidity area? Again, it's the first area that picks up after the imbalance, then is immediately used for mitigation to cause price to go lower. So this is an engineered liquidity area that price must take out after taking out this low and reacting to some order block to the left to cause price to go up there. So then, what do we do? We can look for buy opportunities all the way up to this area. And then after we take out this engineered liquidity, well, what's going to become the next target? Well, some other area of inducement or engineered liquidity, as it's all about collecting gas to then target new gas, right? We have to collect gas higher in order to go lower. We have to collect gas lower before going higher. So if this is where we are, we then want to ask ourselves, well, where's price targeting right now? Well, is there any imbalance? No. All right, here's the first imbalance. This is where price randomly mitigates and picks up. So then this is going to become that first area where price is targeting. So now we're continuing to build lows, and this is going to be the overall goal to make new lows because we've already collected enough gas internally to resume lower. With that being said, we know that we're going to be targeting here, and this could be utilized as, again, an area for us to go higher, but we're not worried about that right now. We're worried about the engineered liquidity. And engineered liquidity is everywhere. Essentially, after you see a huge imbalance, identify where that imbalance stops and then see if price randomly picks up there. And that is your engineered liquidity. Let's look at one more example, and we'll look at US 30. Starting from left to right, when this whole sell-off occurred over here, where are the engineered liquidity areas? Well, first of all, is above this high right here where the first imbalance is, we do have engineered liquidity above here, but price hasn't come back to fill it. So what also happens is, well, let's see, where was the next area price just randomly picked up, made some form of mitigation, and it dropped? Well, right here, nothing to the left was mitigated, so this becomes an engineered liquidity area that price must come back to return to before continuing lower. So after we take out some form of low, we must come back to the engineered liquidity area, which price perfectly comes to, reacts, and then now we ask ourselves is, well, after price came to this engineered liquidity area to collect gas, that tells us that we have collected gas above a high, so now we're ready to go lower, because in order to then go above this high, we need to collect enough gas to go there. And in order to go higher, we must take out lower. So now we need to ask ourselves, where are the two engineered liquidity areas? Well, right here, price just randomly picks up after an imbalance, and then price continues higher. So this is an engineered liquidity area. Same thing over here. We have imbalance right here. Nothing is mitigated, so this becomes another engineered liquidity area. So what happens is when you're selling, you need to know that this will always become the first target. Same thing over here. Price will then continue higher. Where's the next engineered liquidity area? Below low. So after we collect all of these orders, we then come back to where? We've now collected enough gas to the buy side from this inducement for us to go lower. But where's the gas lying for us to then resume higher? Below this low, because it's engineered liquidity, of course, price stops at an order block. Now, in order for us to go higher, we've collected the gas below lows, but now if we want to resume lower, where's the gas? Price randomly picks up right here. Price continues lower, so this is the engineered liquidity area. After we then collect enough gas to go lower, we also mitigate some form of order block. Where's the next area where we're going to be targeting? Again, there's no imbalance anywhere, and all this has been accounted for, so the new target is going to become a new low, aka a major gas station. And if we want to go lower than this point in the future, which we have, we then need to come to collect the gas to go there. So where is the gas going to be lying after we collect a main low? Well, it's going to be lying above these internal lower highs as it relates to the diagram. So we have gas above here because it didn't mitigate anything. We then have gas above where else? We have gas also above here, right? Because this randomly picked up and didn't mitigate anything. So this will become an area where price will need to raid and have some form of consolidation, which you notice it comes up to and it reacts from. And then of course, in order to then take out money to go lower, well, price is then just going to come back to some form of order flow then to go higher. After all this cycle happens and we've then collected enough liquidity, we then need to identify all of the areas of engineered liquidity. So price randomly forms after this imbalance. So this is going to become for sure a target, which you can clearly see price taps into. We then collect it. Of course, we induce a little bit lower, but we're identifying this as all that price needs to collect. And then where becomes the next target? Where's the next engineered liquidity area? Well, mitigated, this is where we have some form of imbalance, and this is where price needs to come to at the least. But again, what's right above is some form of equal highs with further imbalance. This will get liquidated for price to then go resume higher. And after we collect all this internal money, again, below this whole gas, we collected a lot of gas to then fuel up. This will become the long-term target, and all the engineered liquidity areas in the future are going to be where? Still here and still here. So we'll get reactions at these areas. Again, in the future, now we're looking, where are all the engineered liquidity areas for sells? Well, price randomly mitigated here and went lower. We had a huge imbalance, so this becomes a liquidity area in the future, engineered liquidity. At the same time, price randomly picked up after this imbalance and went lower. Well, after going below low, we need to come back and sell above high, so this becomes engineered liquidity, where price comes to take out. After we collect this gas, to go lower, we then need to collect gas below low to then have a pullback. So this is where price collects the gas below this engineered liquidity with imbalance. And this is the only engineered liquidity area besides right here, because this is that whole first area that started the imbalance. But then also this is the first area that picked up after the second imbalance. Then price continues lower. So then after taking out a low, where's the engineered liquidity that price must come back to? Well, again, right above here, huge imbalance. First area price picks up, so it needs to come back to here at the least. And this is the other area where price randomly had a gap. Price did a couple mitigations and went lower. So all price needs to do now is one of two things. We have some form of order block here for price to come to take out all of this, then go lower, or we've already collected the main gas in order for us to maybe have some form of pullback and then go lower because we're targeting new lows. We've already collected the internal money to then resume external, so one or the other is going to happen from here to then cause price to go lower. As far as how do you know which one is enough, where enough money is collected, that'll be posted in a later video. That being said, This covers all things related to engineered liquidity, identifying where price picks up after an imbalance and where price just randomly mitigated to then continue lower. It will only break this point in the future once enough gas on the opposite side has been collected and a strong enough order block has been mitigated to cause price to go higher. That being said, let's get into the wrap up of the video. All right, masterminds, as you all have now experienced, we now know what engineered liquidity is. We know what it is, where it occurs, why we identify it, and how and when do we apply it. When applying this certain pillar of the algorithm, it is essential to know that inducement and engineered liquidity kind of serves as that same purpose. They all both act as the gas stations needed in order to go to the destination, and whether it's on any fractal time frame, the higher the time frame, the lower time frame, the more engineered liquidity that is collected, the more reason, the more gas that we have in order to go to higher or lower levels of pricing to then return to that external range. Thank you guys for joining today's video, and stay tuned for the next video.